Hello, everyone, and welcome back to TradeFinder Live. It's great to be back with you all during market hours. Very excited to introduce Mr. Rob Roy here in just a few moments, who will be discussing today's session and some live Q&A, of course, at the end. First and foremost, we need to cover off our disclosure disclaimer agreement. Essentially, the main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Now, other than that, I feel like we can get right into the exciting topics of this week. The market seems to be waiting on the GDP and PCE reports at the end of this week. We had Biden drop out of the race. Interested to hear what Rob has to think about the impact of, or the potential impact that may have on the markets, and of course, everything else we have going on. So without further ado, the man of the hour, Mr. Rob Roy.
Hi, everyone. Welcome to this week's TradeFinder Live. For those of you that are alert subscribers at ewotrader.com, we talked about yesterday how the close during our Ewo Trader Live session would be important. We do that in the morning on Mondays, and that we might have a little bit more guidance as we move into today's TradeFinder and see how we close today, since this is an afternoon session. And if we take a look at the chart of the S&P, you can see that we did close right on that 10-day moving average yesterday, directly on it. And then when we take a look at where we are today, traded above it, but once again, holding that 10-day moving average. So I think, Zach, you were right on your preview here. I think the market is just kind of hanging in there and waiting on some further economic data. That we'll get the big GDP report on Thursday, and then Friday we get the PCE, the Fed's favorite inflation indicator, just to make sure that we stay solid with the pricing of that September rate cut. As you know, I've been discussing for quite some time. Feel pretty confident in a December rate cut, still a little bit of on the fence for the September rate cut, but the market's pricing it in at a 90% chance, 96% chance that we're going to have a rate cut in September. I don't know. The history of the Fed fund futures is once you get above 80%, high probability, the majority of the time, it pretty much predicts what the Fed's going to do. But we did have that occur in June, and we didn't get a rate cut in June. So nothing's 100%, nothing works all the time, but the market is definitely looking towards that potential September rate cut. And then, as you also mentioned, Zach, we did have President Biden decide he was going to drop out of the race. Kamala Harris seems to be the nominee, but it's not a given. There could be other candidates come forward on the Democratic Party as we move into the Democratic convention. Again, not playing politics, just discussing how politics can affect the markets. That's all we do here. So we don't have a preference one way or the other, just discussing how the move might affect the markets themselves. And as far as the Democratic Party, I think if they do nominate Kamala Harris, that's what's expected. So I don't think that would shake up the markets. If they did start to announce another candidate, or if there's some sort of vote needed to be taken to see who is exactly going to get the nomination, that could create a little short-term volatility in the markets as the markets tries to figure out, well, who else could it be and what are their policies, et cetera. In general terms, and this is being discussed pretty widely on the financial networks in general, the market doesn't like it when one party controls all of Congress and the presidency. They prefer to have a blend because they feel like that lends a little bit more to gridlock and not a whole lot gets done. But if you have one party, regardless of which way it is, controlling the presidency and all of Congress, the market tends to perform, at least historically, worse than that, worse in that scenario. I'm not a big fan, I know some people are, of electoral trends. I know in general terms the market moves up into an election, and that happens a high percentage of the time, but it's just not one of those things that I watch closely. But the market doesn't like uncertainty. And if we start to get some other Democratic candidates challenging Kamala Harris for the nomination, that could create that uncertainty, and we could get a little bit of a tick down. But for now, we're just kind of staying sideways here. and I think that's where we're going to be. Maybe a slight drift to the upside as we move into those big economic reports. The market is more focused on what's going to happen with rates. That's where the market is viewing things. Now you can see that I drew this arrow yesterday that shows that gap that hasn't been filled in the S&P, and that's if we didn't hold this movement here. We did bounce off the 30-day moving average, but as you all know, I put the 10, 30, and 50-day moving averages on the chart. They're exponential moving averages. We've been through that a couple times. Interesting that people have been asking the difference between exponential and simple moving averages. I'm not going to go through it now, but if you're not sure, you can ask that in the Q&A at the end. But the 30-day moving average, I think this was a coincidence that we bounced off here. I think it was more that we hit this little bit of a support level where this line is drawn. And we came down, tested that, and bounced off of it. What I was showing is that we have this corridor of support here around 550 and then down around 545. If we did break below that, we have the 50-day moving average right here at 545. If we were to break that, then maybe we start saying, well, if we're going to break that level, we might as well come down and fill this gap. But we have to break below 550 first, and then break below both the 50-day moving average and 545. So I think we have a pretty good corridor of support here with the 50-day moving average converging right into this corridor. And we're still at that 78.6% fib extension. Not the strongest of all fib levels, kind of coincides with the 23.6 for me in the world of equities. But you've heard me say if you're a currency trader, you're very familiar with 78.6. For whatever reason, 78.6 is the strong level in the world of currencies, just like 61.8% is in the world of equities. So I think we just kind of tread sideways for the next couple of days with maybe a drift to the upside as we wait for those economic reports and then solidify the potential for that September rate cut. So that's where we are on the S&P. Let's just jump straight to the VIX, and then I'll come back to interest rates here in a second. We are moving back down a little bit as we suspected. We had this bounce to the upside here. It goes along with what I've been preaching for however long, that a descending triangle does not indicate a downside breakout. It just simply means that you can break either direction. Any triangle can break either direction. And we broke to the upside. We got up around 17.5, which is where we had kind of run into some resistance here on these past bounces above the 12.5 level. We did spend a little bit of time above that in April, but just this one spike here where we opened higher, but then you can see traded down towards that 17.5 level. So that's acting as resistance here on the VIX, and then we're moving back down, and we're more towards the 10-day moving average. So I think that continues. Maybe a slow drift down in the VIX if we get a slow drift up in the markets, as the market does anticipate a weaker GDP report. Now it's going to be interesting because we have seen this move lower on the inflationary front. Are we going to get a negative reading on the GDP? Are we going to start to look towards a recession, which the bond market has been screaming for quite some time? So if we go and look at the TNX, we came back down towards that 100% level, but it held. So we had broken it, and then we bounced back up. So you can see we broke below it, bounced back above it, and now we're kind of trading here. So there's a little bit of doubt in the bond market, I think, on what could occur in these reports that come at the end of the week. And they're just reserving the fact that maybe those numbers come in a little bit stronger than what the market may be pricing in. And so we're just kind of holding here. But I think if we do get a weaker GDP and a weaker PCE at the end of the week, I think we resume this move down towards a lower set of rates. I feel like that's likely what's going to occur in the markets, but we'll have to wait and see how that all plays out. That's going to be key at the end of the week. And then if we look at the dollar, you would expect some stabilization in the dollar with interest rates stabilizing, and they are. The thing that concerns me here is we still have this qualified 5-wave pattern to the upside on the dollar. Now, we did relabel on interest rates. As you can see, if I go back to the TNX chart, there's no Elliott Wave pattern. We just have this big zigzag pattern. The Elliott Wave pattern relabeled and has gone away. Hasn't happened yet on the dollar, and we don't want to see the dollar get too strong. If we do start to see global weakness, historically, money moves into the dollar. That's the safe haven currency. And even with the amount of debt that we have, it's still in there. I think the dollar hasn't gone down lower because as rates came down, that allows us to service all that debt that we have at a lesser price. But if rates were to jump back up, you would think that that would be supportive of the dollar. But I kind of think that we'd have the opposite move there as well. So normally you have this correlation between the dollar and rates. And one of the expressions in the market is correlations work until they don't. And I think we're breaking with that, where we're kind of holding in here. And if we did start to see a movement down in rates due to the fact that we have poor economic news, that actually could put a bid under the dollar as countries begin to be concerned about a global recession and they run to the dollar, realizing that we can service the debt easier with lower rates, and then we move up. The opposite, I think, could also happen, that if rates take off, like the GDP and PCE report are a surprise, and they would be a surprise if they came in stronger because they're expected to be lower, then we could see rates jump back to the upside, and maybe that brings the dollar down and disqualifies this five-wave pattern. Is now we're back into, it's going to cost us more to service all this debt. So there's a little bit of, I call it discombobulation right now between the normal correlation between the bond market and the dollar. So I felt that was interesting. So we looked at the S&P, we looked at the VIX, we've looked at the dollar and rate. So let's go to the other markets here in the U.S. to take a look at. We did have this kind of vertical move. You've heard me say this 1,000 times. Nothing goes straight up for long. Vertical moves oftentimes get retraced, especially to the upside, and no security in any time frame gets too far from the 10-day moving average. So the Dow has given us all of those numbers. It's interesting because our subscribers that have been with us for a long time, and some have moved on, they stay in touch with us and they comment, but they're no longer part of the alert subscription because they're doing well on their own. And that's the whole idea. The idea of evotrader.com is that we want to educate the average trader. That's my goal. I spent time, as some of you are aware, as a financial advisor. I was a registered securities principal, so I got all invites to the meetings of the principals from big institutions, and they were always focused on the bottom line for the institution rather than the bottom line for their subscribers or account holders, and I just couldn't take that, and I left and moved on, not trying to act like I'm any kind of a martyr. I just feel like the average person has a little bit of disadvantage if they don't have all this education. So the idea here with evotrader.com is that we have the alert service in hopes to have you earn a little bit of money while you learn. So earn while you learn. That's the idea. And then the hope is that at some point you've learned enough to take this information and move on to on your own. And those that have done that, and we've had a lot of people that have done that over the years. We've been doing this since 2018. They come back and they talk about these rules, how they've incorporated these rules. That's why I state them over and over again. One, to drill them into your head, and the other reason is that we get new viewers each and every week. So they're important and they work. And so they should be in anyone's system, whether you're a big Elliott Wave fan, whether you look at the technical system that we utilize here at Elliott Wave Options or not. Those things should be incorporated in your own system, whichever it is that you're using. And a perfect example here. So we're holding above the 10-day moving average on the Dow. We're holding above this 400 level, which I've drawn this line here. So I think that trend continues on the Dow as we move in to these big reports at the end of the week as well. And then as we look at the Qs, I noted this yesterday. We have this big, huge zigzag pattern that started way back at the beginning of the year. And then we had this corrective move in April. We've moved up. And now we have this complex C wave where we have another zigzag that is formed within the C wave. All a complex pattern means is there's a pattern within a pattern, or a wave within a wave, if you prefer that. And so, interestingly enough, both of those two C wave extensions are right around this 525 level on the Qs. So they're both saying that we're likely to continue to move up and should find a home somewhere in that area. I think for that to play out, that needs to show rates coming down. So if we get a weak GDP and we get a weak PCE report, I think that could put another bid into the Qs. Right now, unlike the S&P and the Dow, we're under the 10-day moving average on the Qs. You can see here that we're touching that 10-day moving average on the high today. So reserving that area, we came down, we tested the 50-day moving average. We didn't quite fill that gap, although we got close to it. But we have two important levels here of support that if we do start to feel confident in that second rate cut that comes in September rather than just the one in December, perhaps that puts another bid back underneath the Qs. And the IWM, which, as you know, was wild last week, look what's happening today. It's taken off back to the upside. Holy cow. I don't know what's going on here because most people think that the IWM, the small caps, give a reference of risk on or risk tolerance in the market in general. Risk on, risk off, as they talk about. And when the small caps are doing well, it generally means risk on. However, there's also a view that the small caps do better when rates are lower. But when we go back and look at the TNX, remember, rates have bounced up. So we get a little bit of a tick up in rates, and yet the IWM has turned and headed back to the upside. Is that indicating that there is more of a risk tolerance in the market? Is the market so confident that we're going to get multiple rate cuts that perhaps we're going to get another bid under it? Maybe we get one last run into the election. I think the fact that Biden dropped out drops just a little bit of doubt in there, and the market hates uncertainty, as I mentioned earlier, and it just puts it in there, but yet not strong enough to where it brings the IWM all the way down. The IWM went vertical. There's the rule again. Nothing goes vertical forever. We came back down. We held the 10-day moving average. Nothing separates from the 10-day moving average for very long. So it came right back down, hit the 10-day moving average spot on, and now we're back up today on the IWM. What's going on there? I really don't know because unless you're viewing it as the market has a higher tolerance for risk, it doesn't make sense as far as this view that, oh, well, small caps do better when rates are down, and that's why we're having this big move up. But rates are ticking slightly back up, and yet we're getting a move up in the IWM. So a little bit of confusion there. But the key is, are we now in a new trading range on the IWM? I thought we might actually come all the way down. I felt pretty confident we're going to come down to the 10-day moving average because that's the general rule. But the other view was, if we're going to come down that far, are we going to come down and test 210 because that was resistance for so long? And, you know, what was resistance then becomes support. But we didn't quite make it all the way down to 210. And now we're bouncing back up over the previous 2 trading days. Doesn't make sense. So I don't know what to say about what we're looking at with the IWM. Go ahead and refresh this, and it'll show you, if you like to see the IWM at the top. It'll actually bring it back up there. But it's not making much sense on what's going on with the IWM. I did think, as I said, perhaps we would come back down and get to that 210 level. It didn't happen. So now we wait and see. Gosh, are we going to take off? Where's the new trading range going to be? Are we going up to 230? The IWM historically is like the 20-point range. It was between 190 and 210 forever, then dropped down from 170 to 190. Now we got back above 190, and now we're back above 210, or we are above 210 for the first time in quite some time. So I wonder if that is becoming the new range. The longer we trade above 210, the more likely is that we're done with 210 as being resistance, and the trading range will be between 210 and 230. And then perhaps at some point we do come down and test that. We just didn't do it this time, which I thought we might do. Hasn't happened. Market does what it wants to do. And all we can do from technical trading is trade what the market is telling you. It's the most important lesson that I learned in my trading career. The more you learn, the more you feel like you know where the market's going to go. And I started to trade according to where I thought the market was going to go. I wanted to absorb everything. I was really into the markets. And the more I learned, the more I thought I knew where the market was going to go. That's not a smart way to trade. You got to trade with what the market tells you. You've got to block out what is in your mind, what you think. It's great to have knowledge on the economy. I had economic classes, both micro and macro in college, etc. You learn about the economy, you learn about all these things. The market doesn't always move exactly to where you think it's going to from an economic standpoint. The market doesn't always move, at least for the short to intermediate term, on fundamentals. I will say that over the long term, fundamentals matter. But if you're looking for what's going on in the short term, if you're just focusing on fundamentals, it doesn't always trade that way. So that's why I think having a blend of both is important. Lean more towards technicals, want to see what's going on in the short term, but always like having fundamentals solidly behind it. But technicals being a bit more important. I'm reiterating that because I did a speaking event that I was invited to, and I highlighted that point, and it was for all of Canada. It was really a big report or a big invite, and I was really pleased for that. I've been to Canada numerous times. Was always treated very well up there, and so it was really nice to have an event like that. And so that was one of the questions that was asked, so we covered that completely as far as what's one of the biggest mistakes that the average retail trader makes. All right, so that's our markets. We're just going to have to wait and see if we surge back up, where we find the resistance. The first spike got near 230, but didn't quite make it, and then we moved back down. Let's take a look at the crypto world. We are holding above 65,000 on Bitcoin, which is really important. We came down. We talked about this. We said if we broke 60,000, we're probably coming down to this level here, around 52 to 54,000. That was that little corridor right there. We came down exactly to that. We bounced back up. 60,000 acted just as a short-term period of resistance, then broke above it. That was key. Then the next level is, could we get above 65? We've gotten above that. We're holding that. We're holding above the 10-day moving average. So the question becomes, do we now come up and test 70,000? Again, I think that's likely, and then we'll see, because 70,000 has been resistance for quite some time, pretty much this entire year. So we come back up here, and let's see what happens when we get to 70,000. If we can break above that, we might be off and running, as some people are saying about the cryptos, that we could take off this year and have a big rally in the second half of the year. Well, we got to get above 70,000 first, but if we do, then that's probably going to come true because there's not much to stop it in the way. And then Ethereum, if that's your favorite, as it is with Zach, you can see that we just haven't quite gotten above that 3,500 level. Now, where the Bitcoin has been able to get above 65,000, we haven't been able to get above 3,500 on Ethereum, but we are holding the 10-day moving average. We are holding the 50-day moving average. They're both pretty close together. In fact, all three of those major moving averages are very close, and we're trading right at 3,500. If we can break above that, then we go up and test 4,000. So 4,000 to Ethereum is the same as 70,000 is to Bitcoin. But Bitcoin is a little bit ahead right now as it's above 65,000, whereas Ethereum is just kind of hanging in there around 3,500. So we'll see how those two play out over the next few trading days. If they can break above these resistance levels and go up to the next level, it'll be very interesting to see what happens if Bitcoin gets to 70,000 and Ethereum gets to 4,000. then they're going to have another segment of resistance. And if they can break through that, then, man, it may be off to the races in the second half of the year with the crypto world. But we're not there yet. Looking at oil, we take a look at oil. You can see we've had these multiple zigzag patterns here. Now look what's going on today. We've been holding around this B wave, and we're trying to break below that today. If we close below there, then we're going to have to move this zigzag pattern. And all these zigzag patterns that have been coinciding around a $90 price level on USO, we'll have to reset those. We'll have to reset the complex one. The big one is still intact because that's a low from June. But we would change the complex one, and it might give us a different level. So we'll have to see where we finish on USO. I felt like maybe we needed a correction here. I talked about it. It looked like maybe we weren't going to get it, that we were just going to hold this 10-day moving average. We broke down once and then got right back above it. We talked about that last Thursday night during our insiders meeting, which is for alert subscribers only at ewotrader.com. But we got back above it, and now we're back below it again. So now we're going to have to redraw based on where we closed today, this zigzag that's within the big C wave, and see if it's still showing a potential to move up there. As you know, I haven't wanted to see the USO up at $90. Gas prices are high enough, especially in the middle of the summer, peak vacation time. People are on the road, they're driving. I'm on the road a lot. You know that I like to drive at night just for a number of reasons, one of which is the market, the other which is less traffic. But the traffic has been amazingly strong in the evenings. So people are still driving even with oil prices higher, but there is going to be a limit, at least historically. There's a limit to when oil gets too high and prices just become detrimental to traveling. It just becomes too expensive for the average consumer. There was a question on last week's U.S. market update this past weekend. If you haven't looked at it, go look at it. I think we do a lot in each week's U.S. market update on YouTube. And someone was asking what I thought about the manipulation of OPEC. And maybe that's what they're doing. I think OPEC is smart. They want to keep the price elevated. They know they have a limited supply in the ground. It's become kind of forefront in their minds that, hey, we don't have an unlimited supply of oil in the ground. We want to make as much money as we can over the amount of time that we have oil left in the ground. But they also know that if they get oil prices too high, the consumer will stop and will start buying even more EVs, more electrical vehicles, and it could really bring the oil price down. So they're trying to manage it, in my opinion. This is just my opinion. They're trying to manage where it's an elevated price, but they don't want it to get too high to the point where it stops demand. And so far, I think they're doing okay with that. But if we get the USO up to 90, I wonder if that could be a breaking point where the consumer says, all right, we're gonna stop traveling, we're gonna stop buying oil, and we're gonna buy more electric vehicles. As you know, the initial surge in electric vehicles has backed off a little bit. We'll talk about Tesla. Might as well just bring that up now, and I will look at the metals because we talked about gold. We had that on our preview screen. But you can see what's going on with Tesla here as we get ready for the earnings report this week. And we'll have to wait and see what happens with Tesla after their earnings. There's a little bit of a triangle formation here. I don't think it's big enough to warrant a straddle or strangle. It's very expensive. And who knows what's going to happen in Tesla. With the symmetrical triangle, you have to be open to it breaking either way. I tend to feel like, and that means nothing, it's just my feeling, that we could disappoint on Tesla's report. They did show more deliveries than expectations, and that gave us this big run up. And by the way, this is my absolute favorite breakout pattern when you're dealing with triangles, when you have a vertical run up and then you consolidate in a symmetrical triangle over time, that pattern breaks out. there is going to be a breakout move in Tesla. I don't know if it's to the upside or the downside, but there's going to be a pretty decent move coming, just under a 50-point move in Tesla based on the mouth of the triangle. So I feel pretty certain that there's going to be a significant move. I just feel like probably leaning more towards a disappointment because they cut prices significantly. That's how they got the extra deliveries. That's how they beat the delivery number, is they've been cutting prices. But you can't count them out. Perhaps they've done cost cutting on other areas, and they actually come out with a good number from an earnings standpoint. So you have to respect that as well. It's not just purely, okay, they've been cutting prices to sell more vehicles. They've been cutting costs too. And maybe if they've done a great job of cutting costs, they've absorbed the price cuts in the vehicles, and they could come out with a good number, and you could break to the upside. So that's what happens when you have triangles. You have to respect either direction, and I can justify a move either way from a fundamental standpoint. But the cost of the strangle is pretty high. So I think it's just one of those, let it break out and then make a directional trade from that move. Unless you have a very large account. If you have a very large account, then maybe that's something that you want to consider putting on. And I would be more in favor of a strangle than a straddle in this case, because I think a pretty decent move is going to be priced in to the options. All right, let's look at the metals as we talked about. We'll do silver first because they've been kind of coming back down. As you know, we did a really quick case study consideration at TradeFinder on SLV. Some people ask, why did you get out before you hit the target? It bounced up and then it came sideways and then tried to move higher, and we didn't get that follow-through day. And that was kind of eye-opening, and felt like at this point in time, maybe we just want to go ahead and take the gains. That turned out to be the right thing to do. So that worked out well. And you can see we're down here testing this 38.2% fib extension. We're breaking below the triangle part here. We have the 10-day moving average about to cross negatively on the 30. What is that trying to tell us, if anything, about what these numbers could be towards the end of the year, end of the week? And then when we look at gold, we had a vertical breakout. We actually had a strangle on GLD for our alert subscribers at ewotrader.com. That worked out well. A nice breakout pattern, took the gain, timed that really well because gold's come back down and it's under the 10-day moving average. Now, the thing about this is we haven't tested the point of the breakout of this triangle, and we did do that in silver. So if I go back and look at the chart of silver, you can see that we had this triangle here. We broke out, and we've already tested the point of the breakout. So is silver leading? I think maybe it is. But can silver turn and go back to the upside without gold? They tend to move, as you know, hand in hand. Not always. Sometimes they get slightly different. So maybe gold needs to come down a little bit towards this 215 level and then head back up. All that's going to be interesting. It's going to kind of play in to the crypto thing, I think. So lots of stuff to watch. And I think that this is a week where we don't want to be super active in the world of trading. The market, I think, just kind of wants to go in this small trading range, moving into two big economic reports at the end of the week. And we just kind of watch and see what happens throughout the end of the week. Now, after I've said that, who knows? We might just take off and run one direction or the other moving into the end of the week. But I feel like that's where we kind of want to be. I thought I would throw in UNG. We talk about that from time to time. And it looked right when it looked like it was breaking down and maybe, there's the end of UNG. But we're still trying to hold around this 15 level. If we can do that for a while, and then we start, because the market looks ahead, if we start to look at maybe the winter time again, we're kind of on the cusp there. If we can hold right here at 15, then maybe we can catch a bid and bounce back off of this level, just like we did back in May and June. I don't really understand why we broke there. There was a lot of talk about the heat level in Texas and stuff, and that having an effect on it, but that was short-lived. We came back down. But if we can hold here at 15 and start looking ahead towards the winter time, when historically the demand for natural gas goes up, maybe we can catch a bid at that point in time. So I just wanted to show you that, because just when it looked like maybe we're breaking down and going a lot lower, we were able to come back, and we're trading right here around 15. That's the level you want to watch on UNG and see where things can move from there. A couple international markets to look at. I like to look at the INDA, but I thought I would go ahead and show you Germany. We haven't looked at that in the last couple of webinars, and we're building into this big triangle formation here on the EWG. So perhaps we're going to see some sort of a breakout here. It looks like that's coming for Germany. You can see the lower line there, and then the upper line right through here, forming a point right around 31.5, and we'll see if that ends up being a breakout scenario for the EWG. So let's take a look at the Elliot Wave here. You can see that we're going through a corrective phase following the completion of the Wave 5. Since it went back past 100%, we only looked for a 61.8% correction. That's exactly where that was if you've watched in the past. And now we're going through consolidation. So the EWG is following Elliott Wave rules to a T. Wave 5 ends. If it went more than 100%, you go back to the 61.8, and then you're likely to go into some sort of a corrective pattern, flat, zigzag, or triangle. And it looks like maybe the triangle formation. But I think some patience is warranted here on the EWG. And then when we take a look at the INDA, maybe that's the end of the move there. We came up and we got to one of those points above the 161.8% extension where we were going to do one of three things. We were either going to relabel to a wave 3, which I think will happen if the INDA can move back above that wave 5 high, or it could not relabel to a 3, and we have one of the rare 261.8% extensions. It's happened over my Elliott Wave trading career since 2001, but it hasn't happened very often. And then the other thing is that it's over, and we're moving down towards the 61.8% corrective level, just like we did on the EWG. So maybe we're getting a much-needed break on the INDA. Whether or not you look at the INDA or the Nifty, those are the two primary indicators for the market in India, and they've had one heck of a run, and maybe a little bit of consolidation is warranted here. I would think at this point in time that we're breaking back down. We broke below the 10-day moving average. We came back and tested it. It seems like we're at least going to come down here and test the 50-day moving average. I've drawn a line of support there. There's a little bit of resistance there for a couple of weeks. Forget this craziness with the election. And maybe we come down, test the 50-day moving average and that 55 level, and then see if we can hold there. That'll be an indication of whether or not that wave 5 is finished, and which of those three scenarios that usually occurs when we're at this level plays out. But once again, the prudent thing to do right now, if you've been trading either one of these markets, is just simply to wait and watch and see what happens. Looking at our previous case study considerations, really the only ones we have left now is Microsoft. We've closed everything else out pretty much. We do have COLB, which we had a really quick trade on. That was a real quick case study consideration. So we closed that one off very fast. That was a signal from our AI. Our alert subscribers got that too. So it's nice when that occurs and you see that kind of scenario play out. They don't always run vertically like this, but COLB did. It's in the financials. There were financial stocks everywhere. Some of them had moved too vertically already, but this one gave us an opportunity to participate in that move. And now let's look at Microsoft. And if we look at Microsoft, we have a target up around 475. We had a bit of a pullback, tested the 50-day moving average. We're trying to move back to the upside here. We're off the highs of the day here. and Microsoft still up for the day, but coming into a little resistance on the 10-day moving average. So the key here is, can we get back above the 10-day moving average on the close, and can we get back above 450? If we do, then I think we're off to that 475 level, if not maybe even a little bit higher move on the wave 5. But the key is step 1, close above the 10-day moving average. Step 2, close above 450 with follow through. And if we close above 450, obviously that's follow through from trading above the 10-day moving average. But we've held here at the wave 4. I don't see any reason to take this position off. I think I would stay with Microsoft for now, so we're not going to close that out. We did come down and hold these levels here, the previous wave 5 in March, the A wave on the zigzag pattern from May, and now that becomes a pretty good wave 4 there here in July. So I think we stay with Microsoft and see how that plays out as we look to move forward from this area. So we've been doing awfully well with our case study considerations at TradeFinder. If you go back and look over the years, the record is pretty darn impressive. We've had our losers, but not that many of them. The majority have worked extremely well. We had the gold miners with GDX, etc. So we've done awfully well on these, and we'll continue to stay with Microsoft for now. So what are we going to do for a case study consideration for this week? Well, let's take a quick look at SMCI, which we also still have as the other case study consideration. And it's holding in at this level here around just around the 800 level. And as you know, there's kind of a bid being held here. We haven't had as much of a correction here due to the fact that the speculation is, and there's a premium priced in for that, that they could be the next one to announce one of those big stock splits. And that's really the reasoning behind holding this one as the potential for a stock split moving forward. Unless we break below this level here, call it 800, 790, whatever, I think we would need to break below this wave 3 low, and then we'd be looking at 600. We wouldn't want to hang around for that. But as long as we can hold in this level right here, I think that premium there stays as far as the potential to move up. We got awfully close to testing 1,000. We didn't do it. We came back down. But as long as we can hold this level, then I think we're okay as far as the potential to turn and move back to the upside. So the case study consideration that we have now is one that it did show up on our AI search from the data scientists at hubb.com. And by the way, if you've been under a rock and you haven't gone to hubb.com and gotten a copy of the software, go do it. It's in beta form. It's free. Nothing to download on your computer. Just simply browser-based. And a lot of people have been commenting on how much they're liking it. It's like any new piece of software. You got to learn where all the buttons are, etc. But when you learn how to use it, I think you'll find it's a pretty amazing piece of software. The option data is almost ready, and you're going to be able to look at option chains, create straight trades for yourself, etc. in the very near future. So go get a copy of it. Well, Campbell Soup was on here. We didn't send that one out before because it just was too vertical. It did not reach the AI target. It's come back down. And so we're trading around this 46 level. And as long as we hold above the 50-day moving average, I think we could turn and get another run here up on Campbell Soup. If we look at the DMI, we have had a little bit of a rollover on the ADX, which is not ideal. The negative directional indicator has come up. So there's a little bit of doubt there with the DMI, but it got so vertical that it had to come vertically back down. And that gave us a little bit of a problem with the DMI. But we look at the CCI, which is the shorter term indicator. The DMI, as you know, can be slightly lagging. it's all the way back down to the 0 point. We had this big move up on the vertical move. It's back to the 0 point. So if we can hold here, it's nice to get these vertical moves, but I would rather see just more of a 45-degree angle move here. And if we can see that, then perhaps we can get a nice move to the upside there. So Zach, that's going to be our case study consideration here. Our stop is going to be 45. So we don't have much room here. It's a good risk to reward position. 45 is really good resistance as we go through here and look at these areas from the past. So looking at 45 is going to be support. That'll be our stop. If we break this 10-day moving average and break below 45, we'd get out. But we want to give it an opportunity to go up and hit its target, which is up near 50, the AI tells us. So that's our case study consideration for this week. Zach will come back on towards the end and show you how to post that. That will be an idea, Zach, because it did come from our AI search. And with a few minutes here, go ahead and take some questions.
Absolutely. That sounds great, Rob. Thank you for another phenomenal presentation to get us started into this week. So we'll start out with an interesting one here from Laura. Watch QUBT. Quantum computing is driving innovation in blockchain security, making Ethereum and other cryptocurrencies more secure and resilient. Not many talking about it. Ray Dalio bullish, though.
I'm sorry, what was the symbol?
That's going to be QUB as in Bravo and T.
Wow. I haven't looked at that one in a while. Gosh, that's why I love doing this. It's one of those really inexpensive stocks, so you're throwing caution to the wind when you're trading these. It did have a really nice Elliot Wave pattern. We had the wave 4 right around the 38.2% retracement, and then we came down to the wave 5 extension and came down right around that bottom of the wave 5, right around 100%. We've bounced up, and now we're looking at resistance. So I don't follow these kind of penny stocks that much, but if you're following this, you want to watch this 70-cent level. If it can get above 70 cents, then I think we come back to 90. We got a problem here where the wave 5 technically went above below 100%, below since it's lower, but past the 100% level, which doesn't mean that it has to go back to the previous 4, but it's right there at 100%. And maybe you could see that move up to 90 cents, but it's got to get above 70 cents first. You can see on the high today, it did trade above it, but then came back down, tested the 50-day moving average on the low today. So it's kind of playing a little ping pong here today between the 50-day moving average and 70 cents. I think you just have to keep an eye on this, but if you can get it above 70 cents, you see it tried to do it about a week ago and couldn't hold it, but if it can do it and hold there, then I think maybe you have a run to 90 cents. But for now, I think you just have to keep an eye on it. It's got to get above 70 cents to be long, I think.
Very well. Next up, we're going to go over to a couple of symbols from Manuel. First one is going to be GM, looking at the reversal on that chart.
GM, good old General Motors. And we did get a bit overbought here and came back down. So we had a strangle on this one as well for our alert subscribers, which worked out very well. And once again, we timed it pretty well on the exit, because you can see still have the commentary that I posted on there from the breakout of the triangle. And so we took a quick small gain on this position and felt like it was overbought short term, and now it's come back down and tested the point of the breakout. Is it a reversal? Maybe. But right now, we're just testing the point of the breakout, which is exactly what's supposed to happen. As I mentioned earlier, based on Elliott Wave corrective triangle rules, is after the breakout, at some point, you test the breakout. Now, it works the same way as gaps. This happens an extremely high percentage of the time, But just as with, we don't know exactly when a gap is going to get filled, we don't know exactly when the test to the point of the triangle breakout is going to occur either. This one happened to be rather quickly. So we're back down here. We are trading below the 50-day moving average at the moment. Let's see if we can get back above that into the close. So where we go into the close will be key. If we do close below the 50-day moving average, and then we get the follow through on that tomorrow, well, then we could be heading a lot lower on GM. We might be looking at 40 would be the next area of strong support. But once again, we have to close today below the 50-day moving average and follow that through tomorrow. If we do, then I think that's the next stop is 40. But we nailed the timing on the exit there. And you can see it on your screen. And those of you that are alert subscribers know that as well. So another one?
No doubt about that. The next one from Manuel is going to be Meta and rollover.
Well, Meta has just been defying the laws of gravity, basically, with its move up. So it needed to correct a bit. So it's come down to 72%. So somewhere between the 61.8% and the 78.6% fib levels. Barely held above almost disqualified the pattern, because if the wave 4 comes below the wave 1 high, it's a disqualification. It didn't quite get there, so it's still technically a pattern. We came up and we filled this gap, but we're trading up to the 10, 50, and 30-day moving averages, which are all around the same spot. And we're also dealing with that 500 level, which is one of those big round numbers that I talk about, the Star Trek tractor beam effect. So right now, you keep an eye on Meta, and I don't know, it's not a full reversal yet. Had it disqualified the pattern, we were highly likely to come down here to 400, but it didn't. It held just in time, and it went back up. And so trading around this 500 level, I think you just watch Meta now, and if we can get above this 500 price target, then I think from that point in time, we can look long. And I think you'd have a pretty long trade there on Meta, but we have to see where it goes from here. If it turns around and comes back down, we could be looking at a move to 400. So kind of a common theme here is that the stocks we're looking at so far all are at points where it's just watch and let them tell us where the next move is. There's no need for us just to guess. Looking at Tesla like we looked at before, if you had a large enough account to put a strangle on, you could trade that one. But the rest of them, I think, are just wait and see, because they don't really have great triangle patterns for breakouts. They're just at important points of support and or resistance. And the prudent thing to do is just to keep an eye on them and then trade from there. All right, a couple more, Zach, before you.
Sounds great. Yeah, I just meant to highlight earlier as well. You did a phenomenal job in your symbol coverage, as you covered a lot of the requests in the Q&A. So between natural gas and Tesla, a few others. So well done there. We'll move on to the next behemoth, NVIDIA.
Good old NVIDIA. Good to look at that one. We looked at it yesterday in our EWO live session. So we do that. By the way, we do 2 live sessions for our alert subscribers at ewotrader.com. We do one during the market on Mondays, and then we do one after the market on Thursday nights. So we talk live twice and do a Q&A. So we get both conditions covered during the market and after market. So we start the week and then kind of end the week, which I think is good. NVIDIA held that 50-day moving average. We talked about that yesterday. Wanted to see what we could do with the 10-day moving average at the close. We closed exactly on it, but we're ticking back below it right now. But 120 is just as important as the 10-day moving average is. We need to see a close follow-through day. We closed above 120 yesterday, but this is not counting as a follow-through day yet because we're back down. So we kind of came up, we filled this little gap here, and we turned back as soon as we filled that gap. So once we came up and filled this gap right here, you can see on the high filling the gap, and then we've turned back down. So for a follow-through day above 120, we've got to have a higher close today. If we have a higher close today, then I think maybe NVIDIA is ready to move higher. But that has to happen first, and if not, then you have to just keep an eye on it and see where it goes. So slightly different. We do want to watch NVIDIA, but slightly different here, that if we can close above yesterday's close, so if we can close higher today, then I think perhaps we're going to get another bit of a move higher in NVIDIA. But as I've been preaching for quite some time now, do not expect the kind of vertical wild moves that we had in NVIDIA in the past. It's just not going to happen. Too many shares outstanding now, too many institutions that are siphoning off shares and taking some gains. It's going to keep the pressure on from those moves up. So I think that if we move higher in NVIDIA, we're going to be more on that whole 45-degree angle thing, where we look here and then start to move this way rather than these vertical moves that we had in the past. So still think NVIDIA can go higher. Still looks pretty constructive to me. This looks like an extremely healthy correction at this point in time, but just don't think that you're going to get those crazy, wild vertical moves. I don't think that happens. Maybe it does, but historically, it doesn't play out that way. So let's do one more, and then you come up and show the folks how to put Campbell soup into the website. If you unmute yourself, Zach, we can hear you.
I double muted myself. I played myself on that one apparently, but yeah, unmuting is important. So sorry about that. We'll finish. I was just saying, you read my mind on the last symbol, and we'll head over to a quick demo. We have some positive feedback here from Abhishek saying, thank you for your analysis on the charts. Really helpful. Could you please review the charts for now, NOW, with earnings up next? Thank you.
Service now. There's a lot of speculation here with everything that went on with CrowdStrike, et cetera. We get a little bit of a bounce in CrowdStrike today, but I don't know that lasts. I think that's an oversold bounce, but usually when they go through something like that, it takes them some time. So the oversold bounce kind of occurred today, but ServiceNow could really come in and have something going here. We've got kind of an ascending triangle. So this is one that, once again, if you had a very large account, because you can see it's an $800 stock, maybe on their earnings report they announce a stock split. That's a possibility with the stock trading at 800 as stock splits are coming back in vogue. Gosh, I did extremely well back in the end of the 90s and early 2000s on companies that were announcing splits left and right, and then we went through a period where we kind of went away from the big world of stock splits, and now we've had enough of a run coming out of COVID that companies are doing that again, and so perhaps ServiceNow does that. That would be a really speculative move, because even though it's an ascending triangle, as you know, you have to be prepared for a downside breakout as well, but regardless of what their numbers are, the market seems to like these stock split announcements. And if they announce a stock split, you could get a upside breakout. But aside from that speculation, you just have to be prepared. And it could be a pretty big move. The bottom of this ascending triangle is down around 650, and we're trading up at 750 or so. The resistance is 800, so that's about a 150-point move. So I think we're going to see some sort of a significant move out of ServiceNow. Which way is it going to be? If they miss earnings and they don't announce a stock split, could be a big move to the downside. But if they have a decent earnings report and announce a stock split, you could have a pretty big move to the upside. So that's a good one to finish on, Zach, and whoever asked that, good question, because that one could be pretty wild. Moving into their earnings report. Certainly one to watch for sure.
Yep, that would be a shout out to Abhishek. That was a good find on there. And we will head over to the platform. I see we're 2 minutes after time, so in effort of time, I will make this a speedy demo before posting the idea. A couple things that came to mind that I think I'd like to show for this session are two requests we get in support regarding the functionality of the platform. One of those is being the time axis. So if you go over to a chart, any chart for that matter, I've shown this before, so apologies if this is something you've already seen, but as we know, we always have new viewers, subscribers that are attending, so it's good to go over things for those that have never seen it before and as a refresher. By default, the show footer here in this window is going to be off. If you come here into the chart settings, again, all I did was select settings over here on just random chart, hit show footer. I'll now see down there at the bottom that there is a time zone for me to choose from. After hitting OK, I can go down here to the UTC and select whichever one is preferable to where you are location-wise. If you want to be with the NYSE, then of course you'll go with the Eastern Standard Time there. So that's one thing that I feel is worth showing. And the other thing that I wanted to quickly point out is going to ideas. So I'm about to post a new idea here, and we'll see that process in just a moment. But if you want to look back at your ideas, especially your closed ideas, to see your overall win rate, percentages, to go back and just look at a specific symbol, any of those reasons that it may be, you might find, depending on what computer machine you're on, that you won't see a scroll bar here. And if that is the case, you have the scroll on your mouse that will always provide that ability to scroll down. So if you ever are seeing a page on the platform that looks like it's just, stuck, frozen, and you should be able to scroll down, even if the bar is not there, you can trust your scroll wheel. We've just found from time to time that that's something that subscribers have experienced. But anyhow, we will now go into a new idea. And as Rob mentioned, this is going to be an official idea, not a post. A post would be a draft idea. So as we'll go in, we're going to do Campbell. So we'll just say, so what was that? CPB. And I believe you're saying it was going to test. If it hits 45, that's our stop. But if we're looking for it to go up to a target price of 50, is that correct, Rob?
Let's just call it 49 for now.
49, you got it. And the time frame on that?
Let's just do the 3 months. You showed them how to do the 2 months last time, so never hurts to have it.
So what Rob was referring to there is there's these set intervals of time that you have to choose from, which is convenient. But if you needed something more specific that is not included within these intervals of set time, you can go down to custom and go to the very exact day that you desire. So we will come back to make this pretty as soon as this session is over. But other than that, I don't want to keep anyone longer than the hour that we all signed up for. I see we're 5 minutes past. So thank you so much for taking the time to attend this session live with us. We greatly appreciate it. Please don't forget to hit that like button if you enjoyed the webinar. It goes a long way for Rob and our channel. So I'll pass back over to you, Rob, to wrap things up. Thank you for another great session.
All right. Thanks for all your work you're doing behind the scenes. Zach, I know you multitask during these events. Great questions, as always, from our viewers. We appreciate those. Always like seeing symbols that aren't the ones that we look at day in and day out for every event. So that's always interesting. Appreciate you spending part of your trading day with us. We'll get back to it, see where things close today, and see how the market handles moving into the end of the week with those big economic reports. So kind of a wait and see mode, I think, as far as the markets right now. So thanks again. Look forward to talking to you soon. Take care, everybody.